Good morning everyone, this is Amit Pabari, founder and managing director of CR Forex. Dollar index has a strong supported 100 level. If you see the chart, it took 5 years for dollar index to break resistance of 100 level. From 2015 to 2020 it was struggling to break 100 level and move higher. Now that 100 level is going to act as a very strong support for dollar index and likely to move higher. Now let us understand why. The first data point to analyze is that US job market is rock solid. If you see the data point, the unemployment rate is at 53 years low. Apart from unemployment rate at the lower level, their average hourly earning is also increasing. That puts a pressure on Fed that they really want to pause increasing the interest rate in the June and July meeting. The second important reason is stronger US economic data. Currently, the entire market has only one narrative. Basically, entire market is thinking that Fed will be less aggressive than ECB, European Central Bank, or Bank of England. They will be increasing more interest rate as compared to Fed, because of which the dollar index is currently in the pressure. But in order to evaluate any currency, we have to see what are the fundamental factors. And if you see the data point, it is clearly indicating that US economy is much stronger than European economy or UK economy, because of which we think that dollar index will take support and move higher. Now let us discuss outlook for rupee. The rupee has taken good support between 8160 to 8180 kind of a level, because RBI has been buying dollars aggressively. We believe that we will see a weakness in the pair between May and June, and ideally the pair should move towards 80 to 83 kind of a level because of following reason. Reason number one, DXY to take support at 100 and move towards 103 kind of a level. Second, trade deficit of India will increase as we are now not going to pay for buying oil from Russia and rupee. It will be in other currency. Third reason is that Chinese currency and Japanese currency are showing some amount of weakness in last 15 to 20 trading session. If that continues, then it is going to put pressure on rupee. And finally, any escalation between Russia and Ukraine or China and Taiwan, it can keep a lot of pressure on rupee. Now let us discuss strategy for thin margin exporters. Thin margin exporters have been taking costing between 8150 to 8180 kind of a level. We will suggest them that they should keep a stop loss of 8160 or costing whichever is higher, and they should cover in the following manner. Cover 60 to 70% of their exposure between 8190 to 8210 kind of a level. For remaining position, they can wait for higher level between 8220 to 8240 kind of a level, but stop loss is strict 8160 or costing whichever is higher. Now let us discuss strategy for thick margin exporters. The market is testing patience for thick margin exporters as they have been waiting for a longer period of time. Ideally, they should continue to wait with a stop loss of 8150 for a target of 8250 to 8280 to increase their hedge ratio. Now let us discuss strategy for importers. History is suggesting that whenever the volatility is low, which can be measured in terms of vols in option, if you see the vols in option, currently it is trading at 3 years low. History suggests that whenever the volatility is low, a breakout will come. And ideally in next 8 to 10 days, we are expecting some kind of breakout in dollar rupee pair, ideally on the upside. So ideal strategy at current situation is that importers should be covered for next 45 to 60 days import, and any dips towards 8160 to 8180 is a good opportunity for them to hedge their imports for next 45 to 60 days. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week.